Hello, everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have Paul Ghezzi, the CEO of Kontrol Energy Corp. Before we get started, I want to remind all participants that your microphones have been muted. And at the bottom of your screen, there's a chat feature, and we encourage the audience to ask questions by using this feature. Kontrol Energy trades on the Canadian Securities Exchange under the symbol KNR and in the US under KNRLF. The company has roughly 30 million shares outstanding and a $10.5 million market cap. I'd now like to hand it over to Paul Andriola.
Thanks, Trev. Yeah, we're happy to have Paul Ghezzi, CEO of Kontrol Energy, as Trevor said. Thanks for coming, Paul. You're a company that we've spoken a little bit about in our subscriber forum, but we're happy to have you here to give everybody a chance to really understand what you guys do. So, I'd like you to start off by just doing just that. Just tell us exactly what you guys do.
Sure. So thanks for having me. In very simple terms, we make buildings smarter in real time. We do that through software, hardware, and solutions. The market we serve is about 100 billion annual USD. It's a commercial, multi-residential, industrial buildings. And our platform has been in existence for 4 years. We started this at $1 million. We're running at about 15. And despite COVID, this may be our best year.
Wow, fantastic. So give us a better idea who your typical customers are. Who's your sweet spot as far as customer?
Sure. So there's really two, when you talk about smart buildings, there's really two verticals. There's energy and emissions. And in terms of our customer base, we have a tier one blue chip customer base, which would include Toyota. We can talk about the Toyota strategic partnership. We just added Beyond Meat last year, Suncor, Enbridge, Lafarge, large blue chip names, great customers, and both the energy and the emission sector.
Mm-hmm. Okay, perfect. How big is this market for specifically what you guys do?
So we define the North American buildings market, and that's primarily our focus, as about 70 billion a year USD. And that's growing at about 10% per annum. And then the emission market, the emission compliance and monitoring market is about 30 billion. So combined, we're dealing with about 100 billion annual energy market just in North America. And we've recently announced that we're moving into some initiatives in Europe, which we can discuss from a recent press release. And so, it's quite a large market. The idea also is that the market is growing at double digits every year, and we feed into that. And it's a market that's consolidating around us. So large cap players are gobbling up companies. We're growing, and maybe that's part of our future as we get to about 100 million market cap is maybe we're taken out, but it is a very robust kind of market right now in both verticals.
Right. So you guys save your customers money through energy savings. Get a little more specific in terms of how you do that.
Sure. So we have a patented technology, software and hardware. And so let's say you've got 100 buildings that you're managing or that you own. And you could be in the real estate business, or you could be an industrial customer that's looking for deep energy savings. So we use our patented software and gateways to go into the building, extract information, run it in real time, run smart algorithms, do deep learning on the building, come up with a plan, and then we transfer that into a software as a service opportunity. So that's on the energy side. And typically our customers are looking for paybacks in the 2-year range, which means if they're buying our service, they've got a very fast return in their business. And on the emission compliance side, we're installing equipment that monitors emissions. That's more regulatory. And so companies really don't have a choice on that side in terms of reporting to the government. So from both those perspectives, it really comes down to software, hardware, automation, managing all that in real time and delivering that to the customer and providing those analytics.
So you mentioned Toyota as a customer. Maybe give us a sense of how, what does that contract look like in terms of size, and maybe how does it roll out with a company, a customer like Toyota?
Sure. So about midway through last year, we signed a deal with Toyota where what they're looking at is they've designated themselves to be a net zero company, which means net zero emissions by 2050. And so they want to take each plant that they operate to net zero. But in order to do that, you need a data analytics and software platform. So we've established a smart factory partnership. And the smart factory is defined as utilities, building automation and management, and facilities and production. So what we do is we put those online, get all that data flowing to Toyota. They take that from factory to factory. And so what that means roughly is each factory is worth about $1 million of CapEx upgrades. But the way Toyota operates, like most large industrials, is they have a 5-year CapEx budget. So we go in year one and we establish the first year baseline. We install our sensors and our software. They stamp it with their logo, and now they're putting each plant online and managing that in real time. And so they're going plant by plant. They have 200 plants across North America, which includes Canada, US. They've also got a few in Mexico, which we're looking at. And it's a very substantial partnership for us. And right before COVID, we had done 10 facilities that we had walked through. We had started to initiate in 3. So we've got 3 facilities going. And COVID's been a bit of a disruptor there, only because they were shut down for 2.5 months, like the rest of us, and now they're opening up. But it is a very substantial partnership. Right now, we're the only supplier to them in this particular stream, and we look forward to growing this in Canada and the US significantly.
Okay, so you mentioned the word COVID. That's something we're dealing with today. How has COVID affected your operations? And then second question on that is, do you see any longer term upsides or downsides because of what we're dealing with COVID?
Yeah, sure. So great question. So in terms of our business, we're defined as an essential service provider. So what that means is we're out there, customers need what we're supplying. So we've been open during the whole COVID crisis. We haven't seen a slowdown. So we've issued about 40 million in proposals this year. We typically win about 40% ratio. So that puts the year at a certain number of 16 to 18 million, which is better than last year. Well, where we have seen a slowdown is if one of our customers has closed their plants. We can't get to the plant to do what we do, so that's going to get deferred from Q2 to Q3 and Q4. So I think we've seen the biggest difference in projects in Q2 being moved to Q3 and Q4. We haven't had any orders canceled, which is great, but certainly we've seen the shift. If the entire plant's closed down, that's going to move into Q3 and Q4. So from that perspective, COVID really hasn't hit us that hard. It's more of a timing issue because of the nature of our business. But long term, I do see changes in the way buildings are managed. In our case, if the building has to be in greater compliance, it's actually better for us. If the ventilation system has to be better managed, it means our software and our solutions are more opportunistic. So I view it as a bit of an opportunity for us, despite the downturn that the economy has gone through, just because of the nature of what we do. But certainly there will be changes to the real estate market and how buildings are managed for sure.
Yeah, no doubt. No doubt. Maybe give us a sense, like how does a customer pay you? Is there a SaaS component to it? Give us a sense of any
Sure.
other costs, or what's the business model, I guess?
So we have a pretty simple business. So we say every building is a customer and every building makes us money. And there's 3 revenue streams. One is defining a project, so installing something that needs to be installed, or we would call it retrofit, because we're not in the new construction market, we're in the retrofit market. Then there's a software as a service component, and then there's a building service component. So those are the 3 revenue streams. Software as a service is often the lead to get the project and manage that project in real time. And then we have a service business. So right now the SaaS business is about 80% gross margin. The service business is about 60%, and the project retrofit business is about 35 to 37% gross margin. And what happens in our business is in the first year, the project is the revenue engine, but over the long term, the SaaS and the service grow. So right now, the entire business is running at about a 45 to 50% gross margin. We want to get that up to 55 to 60. And as the revenue grows and that gross margin stays intact, we become highly profitable. And we're really at the tipping point. We had a good year of positive EBIT last year. This year is looking better. And that's how the business really operates, those 3 revenue streams. But most importantly, software and service grow over time to be a bigger component.
Cool. Okay, so you touched on revenues. did roughly 14 million, I think, last year in annual sales. You've announced that you targeted a run rate of 100 million in 3 years. How do you get there?
Yeah, so a great question. So it's a combination for us of good organic growth north of 20% and acquisitions and combining those two. And we've got a small acquisition on the go right now that adds 100 buildings to our portfolio, which is significant. It's about 4 million of revenue, 800,000 bottom line, net EBIT. We're paying about 3.5 times for the business. But those 100 buildings become a platform not only for the revenue that we're acquiring, but also the opportunity for us to add all of our software and hardware sales into those 100 buildings. And so as you get a new building and you're cross-selling, the revenue accelerates substantially. So it's really a combination of strong organic growth and accretive acquisitions. On the acquisition front, we've done 5 acquisitions. They've all been successful. We're very picky. Last year, we didn't do any. This year, we've targeted 2. And the nice thing about Kontrol is we only raise capital when we're doing something strategic. We don't need to raise capital to run the business. We're EBIT positive and just above cash flow break even, which is where we want to be with high growth. And so we are looking at a number of strategic opportunities in the US and Canada.
Now, you had an acquisition that you were going through that you canceled. Able to tell us what happened?
Yeah, so sometimes the challenges of buying private companies, they're interesting. So we had a target in mind, good company, didn't have recurring revenue, but we thought we could add the recurring revenue. And when it came to their financials, they just couldn't deliver audited financials. They went through 2 accounting systems, and it's quite typical of private companies really not to be prepared to be public. And I think it can be a shock sometimes. So that acquisition has actually changed our process and the way we do things. What we do now is we kind of force the financial position first, the share purchase second, once we're clear that the private operator, can deliver on those. So it was really a combination of them not delivering, us losing interest, and finding something better. And I always say sometimes the best deal is the one you don't do for the right reason. And I never feel pressured to do a deal, right? Even if I'm in the middle of a deal and it's not working, I never feel pressure to do it because I'm a big shareholder here. Insiders own about 46% of the company. And we're thinking about this from a long-term perspective. And so that particular deal just fell off the table. And the one that we have on the go right now is much higher recurring revenue and is a much better fit long-term to where we're going.
Okay, so M&A is a big part of your strategy. Obviously, a lot of that is really dependent on the management team, their sort of skill set or the capability. Well, why don't you give us a sense of your background and
Sure.
your team's
Yeah, so I started my career as a CPA a long time ago. I got into the M&A field being a CPA. I spent some time at Bombardier, then went on my own and was involved in a number of transactions. Spent about 7 years in the solar industry consolidating and did really well with that. And when I was looking around for my next opportunity, we saw certain trends in Europe where large power plants were no longer being requisitioned by governments, and the entire market, this is about 2014, was moving to a conservation platform through technology, where basically you're using less energy in every building. And buildings contribute 40% of greenhouse gas emissions. So those 2 things I saw as kind of a driver in North America about 2 years post Europe, and that's turned out to be true. So you don't see a lot of large power plants being built in North America. The real focus is on how do we do more, or how do we do more with what we have using technology. And so that's my background. My CFO is very similar background. He's an M&A guy, used to be at Bombardier as well. And our COO is an industry fellow who's been in this industry for about 20 years. So together we run a very tight team. We keep overheads low. A lot of work we do internally. And in terms of deal flow, we're not out there looking for deals, but if there's something very strategic that really fits the business that we think we can get operating leverage out of and grow, we're going to target that specifically. And it's a little different than a roll-up strategy where you're constantly looking for something to buy. We're much more strategic in our focus, and we want to see the operating leverage in the business that we can scale. So, the next acquisition, we look at it as an opportunity to triple their revenue over about 18 months because we've got 150 buildings that we can sell their service into. They've got 100 that we can sell our service into. And if we merge that, there's a lot of power in that leverage.
Wow. Okay. So I mean those are the ideal sort of synergistic M&A opportunities.
Right.
To do that, right?
Right.
Fantastic. Your last business, you had a successful exit there. Can you give us a few more details on that?
Yeah. So I was kind of fortunate in my timing, and a little bit ready. I had started Canada's first solar fund, and I was doing some M&A work in Germany for a customer, and I fell in love with solar, but the power side of solar, where you're clipping a coupon from the grid. And at the time, this was like 2006, 2007, solar funds were on every corner in Germany, banks were selling them.
Mm-hmm.
And I thought, here's a great opportunity. I'm going to take a solar fund from Germany and bring it to Canada. And so I was about a year early, but then we had our energy minister at the time announced our Green Energy Act in Ontario and basically copied the German Renewable Energy Act. So I was a bit lucky. And I was very familiar with that, had all the banks ready, and was one of the first ones out of the gate. We were getting, if you can imagine, 80-cent contracts back in the day when the price of energy was 10 cents. So the arbitrage was 8 to 1.
Wow.
And so developed that, sold most of it, and was looking for the next rodeo. And so that was more on the private side of the business, and decided that the next adventure would be public.
Cool. Okay, let's get back to. I'm interested in learning a little bit more about your sales process. How do you guys go and find a lead, find a potential customer, and then what's the process and time to where you hopefully sign them and get your money?
Sure. So we have 5 full-time salespeople, and basically it's you work your existing customers for more market share. So we're constantly in touch with our customers. What else can we provide you? How many other buildings do you have? What have you acquired? So as an example with Toyota, we've walked 10 buildings. We're working on 3. They're out there actually in the field getting us more buildings. In terms of an institutional customer, we may be in 10 of their buildings. They may have another 20. So we're constantly pitching for the next deal. In terms of finding a new customer, it's really just aggressive sales, calling, CRM, presentations. It used to be a lot of road shows. I think that's changed for all of us right now. So trade shows, road shows, and really having a defined offering where we can get into a client's facilities. We've also gone the route of fast track pilots. And the reason we do that, and Beyond Meat was a great example. So they weren't interested in what we had to offer, but we defined a pilot, we fast tracked it, gave them the pilot for free. And then they said, wow, this works. Let's start looking at other facilities. So we've got a pilot process now that we run. If we're meeting sales resistance, we just offer the pilot, and we know how to run it very quickly and get the data, share that data with the customer, get them really excited, and then move them to a sales process.
Is there any cost to the client to do that?
So typically we've offered our pilot at no cost, but they've got to provide us with some on-site labor to support the pilot.
Right.
We take the risk of the pilot, but giving our closing rate, we know we're going to typically win the engagement. And what we're really after is a customer not that just can give us one site, even if it's a large site. We want a customer that has, hundreds of sites or dozens of sites where we can duplicate what we're doing, and it's just not a one-off. So the one-offs are sometimes appealing because of the branded customer, but if there's no scale, we're really not interested.
Right.
So with Beyond Meat, we were talking about 6 to 10 sites. With Toyota, it's 200. We just announced that we're working with a global OEM, original equipment manufacturer out of Europe. They've got 20,000 sites. So that's really important to us, is the customer has to have a scalable platform that we can scale into.
Right. And what's the average dollar per site? Can you give us a sense of a metric around that?
Yeah, for sure. So it's typically between 150,000 to 250,000. So we would call those small projects. But if they're scaling, across thousands or hundreds, that's where the scale happens in our business. The largest project we've done is probably 800,000 to $1 million in terms of one site. And so what we're really focused on is the larger project revenue in year 1, but we really want the SaaS revenue over 5 years.
Right.
And that's where we're going to get that market valuation that we're looking for of 3 to 4 times revenue as those recurring revenues build up.
And just on the SaaS component per site, what does that break down to, do you think?
So typically on a project basis, you're looking at about 15% of the project would be defined as SaaS, 15% would be service, and 70% would be one-time project with opportunities to expand that project over time.
Okay. And what do you see as the typical, what's the pushback? Why would a client not go ahead with this?
Sometimes it's CapEx driven, so we don't have the budget, even though the return's very high. I've spent my budget for the year. I don't have the budget. Let's talk next year. And that's when we introduce the pilot and just say, okay, well, let's run that for 90 days and see what you think after the pilot. The other one is a lot of large companies are building internal teams, and sometimes those internal teams become resistance points. So as an example, Toyota at every plant has a facilities manager, right? And sometimes that's a gatekeeper trying to keep you out. But if you've got Toyota management on your side, that's how you break through that barrier. And then the other is sometimes we're in competition on RFPs or RFQs where you've got to deliver, relative to your competition. But we did win the Toyota deal by out competing numerous much larger firms than Kontrol. And the reason we won it was our technology is highly scalable. It was very effective in terms of communicating Wi-Fi, Bluetooth, IoT, and we were at a much lower price point, even though our margins are very high. So every situation is slightly different, and you're typically breaking down barriers to get the sale.
Mm-hmm. And any areas you want to move into, or are there new products, any changes that you're working on to? Right
yeah.
now?
So the way we think about the world is the building world. As much as we think everything's evolved, and we're always on our phones and everything's digital, the building world is very analog. And so our view is, the more customers we bring on, the more we can share that digital experience where they can take their entire facility online in real time, the more they want to keep doing that across other facilities. So from our perspective, we really want to build a platform that gets the customer there quicker, more efficient, breaks those barriers down, creates that experience, and then they just want to keep repeating that experience. And so that's what we're really focused on from our side, which is more upfront software development, more customization, and more scale is really where we want to go.
Mm-hmm. And I mentioned a lot of the hardware you're installing is mostly third party. I doubt that there's much in the way of hardware that you guys are developing.
So we've got one hardware product, which is our flagship. It's a smart thermostat. So think of it as Google Nest for commercial. Mm-hmm. And that's really a high gross margin technology product with SaaS revenue that we own, the IP and the patents. In my view, anything that's a commodity that belongs in a project, like a boiler or a chiller, that's part of our solution through our software. Anything that's commoditized, we're not interested in. The margins are too low, but anything with a high margin that we own, we want to integrate the project.
Mm-hmm. Cool. Point, what are the metrics we should be watching for here? What, number of buildings, number of sites, number of, give us a
great question. So I would say, a couple of things investors should know about us. One, we started this at $1 million, 1.5 million. We're at about 14.5. This year, we're looking at something better than that, in the 17 to 18 range. So I think we've delivered on our revenue growth within expectation of what we wanted to deliver. Two, the more buildings we accumulate and get under management with our program, the more money we make. It's pretty simple. Every building equals X amount of dollars. Mm-hmm. And three, I think if you look at where we're going in terms of international, we've got our first international opportunity outside of North America. And so I think we can start to put some metrics around, a customer expansion into different sites. So we've got a global OEM right now with 20,000 sites that they manage HVAC equipment in, and we're giving them our software platform. So I think that's another example of a scale metric we can start to look at is how many sites are we scaling into. Mm-hmm. If you take all that, revenue should continue to grow, based on where we think it's going. and it gives a pretty good idea of the trend that we've built. On the valuation side, it's really interesting. So every CEO is going to say they're undervalued. That's CEO's job, right? Except Elon Musk. So, but from our perspective, if you look at the industry trades at about 2.5 times revenue. We traded about 1.5 to 1.7, and my view on that is we've spent more time building our business than we have in the public markets. Like, for example, this is the first time we're speaking on your platform, right? And we haven't spent as much time in the public markets telling our story as we have been building the business. And in my view, it's way better to tell your story when you're executing and delivering than to be too far in front of that. And so I think as we change that and we get more vocal and we share our story, the valuation will start to change as well. And I think that's important for us to continue to do that as we execute.
Good. I'm going to open up questions to our listeners. So feel free to start posting some questions in the chat. I see a few you have already. Let's talk about sort of the business or the income statement, balance sheet, that sort of stuff. You guys are carrying a little bit of debt. Can you give us some details around the debt and your balance sheet?
So I come from the solar industry, so this will kind of explain it. In the solar industry, we used to leverage 90-10. So why did we do that? Well, the projects were defined, the bankers were willing to put in money, and it was long-term money. And so my thinking in building Kontrol was, we're going to start it at 70-30, and that's the model we're running right now. And so what that's done is kept our share count under 30 million. We've never done a rollback since being public. We own 46% of that 30 million. Another 15% is what I call long-term hands. So the true public float might be 7 or 8 million. I think we have one of the best common share structures in Canada. We haven't been rewarded for that yet. But the idea with that was, okay, well, let's use the debt to fuel the growth, and let's use the common equity as a top-up when we need it, really control our share structure and drive value. So on the debt side, the majority of our debt is unsecured, and about 5.4 million is rolling every year. So we rolled that forward last year. It's sitting on the balance sheet as current. The plan is to roll that forward again next year. So it's unsecured, pays an 8% coupon, and is not convertible. About 3 million of our debt is senior secured with a company called Firepower Capital. So they helped us close our last deal. And the rest of our debt is convertible. So that's about 10.4 million of debt. So we think it's manageable, that we've been managing it that way every year. What we would like to do at the right time and at the right price is an equity round, maybe with a larger transaction, and go to a 50-50 model. But it's kind of interesting in Canada and small cap, and I didn't realize this coming into the public market, 4 years ago, you are penalized for using debt, and you're not rewarded for a great common share structure. Now, that's a point in time, right? That can change in the future. You're more rewarded for momentum and volume in your stock price. But the way we look at it, we're owners. So I'm not selling my shares, building value. I would rather have a really tight equity structure as opposed to, a stock that's trading volume with 200 million shares outstanding. So that's the thinking behind what we've done. We think it's logical and strategic, and so the market maybe doesn't agree right now, but we look forward to changing that impression. And I do ultimately think, scarcity matters. At the end of the day, every company, no matter who they are, has to deliver earnings per share, right?
Yeah.
The fewer shares there are, the better your chance of executing on that in the future. So that's our approach. We look at companies. A couple of examples I look at are Well Health, which you and I have talked about, are through email, and Zebek. Kind of similar, took on debt in the early days, grew their business, had a pivotal moment, raised equity, have done really well. Both have done really well. And I look at both of them as kind of models that we're following with our approach. And I think it's sound. You just got to create the catalyst. And I think we're very close. And then we get that revaluation in our share price. Some of the debt's refinanced and everything looks fantastic again. So that's our approach. Hopefully not too long-winded, but I wanted to give you some insight into that.
No, for sure. No, perfect. I happen to know another small company that is carrying a bunch of debt as well, structured the same way as you are. And I share your frustration. I'm the CEO of that company, so I know what you're saying. So the last equity financing, though, what price was it and how much you guys raised?
So we've got a really interesting story in our stock. So we went public at about 5 cents, right? The way we did it, which was a little unique, is we took our private perspective. We incubated ourselves. It was the depth of the mining despair. So this was like 2015.
Mhm.
So I bought a shell. Essentially, I bought the shell myself. I funded it myself. We used a few brokers. At the time, we thought, okay, we're really smart guys here. We're doing this great transaction. We're keeping it out of everyone's hands, which wasn't really the right thing to do. But because you got to spread it around on the street, right? And I've learned that since that in the public markets, you got to have some dispersion across the brokerage community. So when we did that, we went public at about 15 to 20 kind of the next day, once we were listed. And we raised a little bit of money at 20 cents, maybe like 1.5 million shares to 1.8 million shares. We did our next round at 60 and our next at 70. Most of our warrants are at 70 cents and 80 cents that we have outstanding. Most of our options are above 60 cents. And the average cost in our stock, we've done the math on this, is about 55 to 60, which basically means, the average investor is slightly underwater. And primarily because of COVID, we hit our COVID low about 21, 22 cents. We were at about 60, 65. And we've recovered a lot of that, but not all of it. So I would say it's a great structure. The average cost is 55 to 60. No cheap paper. There's no cheap options or warrants. Management owns a big position. I've been buying over the last 4 years, adding to my position. And so that's where the stock is, which I think is in really good shape structure-wise. Now we just got to get the valuation moving in our favor.
Sure. And I can't remember if you mentioned it, but directly, how many shares or what percentage do you own?
So right now I own 18% directly, and my family trust, which I'm a trustee but not the sole trustee, owns another 18%.
Okay.
So I'm at about 36%.
Okay, fantastic. Fantastic. Okay. Why don't we open it up to the questions? I'll start taking some of these questions right now. Does your work overlap with what mCloud Technologies does?
So we see mCloud quite a bit in the public markets. I don't see them in our client base. So it's really interesting. So I would say they're more of a public market, capital market competitor. And there's lots of room for everybody, but I don't really see them too much in the industry space. We're not really heavy into oil and gas. And I think they did a major oil and gas acquisition. We're much more industrial, multi-residential, and commercial spread out. We have about 5 to 8% of our business in the oil and gas sector. So I don't really see them too much in the industry. It's interesting. They trade at about 4 to 5 times revenue. So I'm not sure, what that means, but we're trading at a much lower revenue valuation. So I do see them in the public market. I don't see them too much in the industry from my perspective.
Mm-hmm. And maybe it's a good chance to ask just maybe some of the other competitors and where you see,
So I'd say in the Canadian public markets, you've got mCloud, you've got Legend Power, which I think was incubated out of Vancouver. You've got Internet of Things. On the large cap side, big cap competitors would be Honeywell, Siemens, Schneider, Johnson Controls, and in our industry, there's a lot of small private companies in the $2 to $10 million revenue range that are being consolidated. So it's kind of a cross section, but yeah, in the Canadian public markets, there's a handful of competitors.
So, what would you say your company does better than anybody else in that sector?
I think what we do the best is we can get into any building extremely quickly, right? And win over a customer with our software, get that software very sticky, and have that customer become a repeat business customer. So for example, we were able to get Beyond Meat as a customer in about 4 months. We were able to get Toyota in about 5 months. We outcompeted some of the largest guys in the industry. We've just signed with a global OEM out of Europe that runs about 600 million of revenue. We have more of those in the pipeline. They take about 6 months to get, but we can do it efficiently with the software. And I think, we're very comfortable now in basically saying to a customer, here's what we can do for you. Here's how fast we can do it. Let us show you, and let's close something in 90 days. So I think we do that really, really well. The other thing I think we should get credit for that we don't is we've done 5 acquisitions. We have had 0 write-offs on those acquisitions. So every year, as people know, your auditor has to do a test on goodwill and intangibles. And that test basically says, did you overpay for what you bought? I think if you study everyone's financial statements, you could see we've never had an impairment or a write-down. Basically means we're buying for great value. We're not overpaying. I mean, if you look at the cannabis sector as an example, there's billions of overpayments and write-downs that are hitting balance sheets right now. We haven't had a dollar written off, which means we're acting like good stewards. We view ourselves as shareholders and operators together. So whenever we do an acquisition, whatever capital we're using, our capital is there as well. And we really take care in terms of doing that well. So I would say the software and then the acquisitions together, I think we've delivered on both.
Cool. Okay, here's a good question. Are there existing technologies in a building that need to be there for you to be able to work with? Or basically, is the market restricted to newer buildings?
Okay, so every building that's been built over the last, say, 40 years has something called the Building Automation System, BAS. And a BAS system is essentially a hardware and a wired system in the building. So if you think about a building, 70% of a building's energy consumption is through the heating, cooling, and ventilation. And that's the problem that we're attacking in real time. So we can tap into any BAS system that's about 30 or 35 years old. So in a square block in New York, there may be, say, 50 buildings. Each of those buildings may have a different building automation system. Our open protocol software can speak to all of them at the same time. And we've got about 15 different communication protocols that we've developed where we can go get that data quickly, efficiently, low cost, and high margin to control. So as long as there is some communication protocol, we can get it. If there isn't, we'll just install it on the equipment and start communicating with it.
Right. And this is a question I should have asked, but a typical building, is there a sense, can you give us a sense of what a building owner will save by using your
so we're in between 20 and 30% in energy savings, typically with a 2-year payback, which to a building owner is about a 50% internal rate of return. Now that happens over time because you've got to go through heating and cooling seasons and making sure the equipment's running properly. But it's 20 to 30% on average. And in terms of emissions, whatever you're saving in energy, there is a corresponding reduction in what you're putting out in emissions. And buildings right now contribute to about 40% of global greenhouse gas emissions. So it's a combination of reducing the energy costs, giving them data in real time. So one thing I should point out is we now have 30 billion data records that we've sorted through and managed in real time. Those 30 billion data records are basically, every piece of equipment, every building, hour by hour. So when we take on a new customer, even though they may have 10 buildings, they don't have the amount of data that we have on those buildings. So that data is going to become very valuable over time. And right now that number is sitting at about 3 billion or 30 billion, and we're adding about 5 billion a year. So that number keeps growing. So there's really no system we haven't seen or worked with, which allows us to be very efficient in the way we get into a building, install our software, and get very sticky. The other thing I should say is our rescission rate or our loss rate with a customer is less than 1% a year. Typically, we lose a customer if they're selling their building because then we've got to go pitch the new customer and get into a sales process. But 99% of our business is sticky. So once we get it, it doesn't leave us.
And how many customers do you have? Is there a rough number?
So we're sitting at about 60 customers, which I would call tier 1, and then about 50 customers, which I would call tier 2. And the tier 1 are the groups that have the really large portfolio platforms, and the tier 2 are the ones that would have a portion of that. So, maybe 10 buildings instead of 50 or 5 buildings instead of 100. But in our tier 1 customer base, they're typically multinational, global facilities across North America and facilities globally.
And is there any one of your clients that, it has more than, say, 10% of your current business?
We're fortunate that way. I would say about 8% would be the peak. Although what's going to happen with Toyota is they are growing faster than other customers. So they could be a dominant customer in terms of the size of the portfolio pretty soon. The way we would counter that is really just keep adding new customers. And so the press release that we issued a few days ago on the global OEM, they've got 20,000 sites globally that we can work on. So they may become a dominant customer. But I think from our perspective, we just want to keep adding great customers. and not really be beholden to any particular customer. And I think that's kind of, that strategy has worked well during COVID as well, because we've been widely dispersed, and business has been pretty good.
Cool. There's a secondary question here, but you mentioned data. Do you see any other way you can monetize that data?
So what's happening right now with the data is when we onboard a customer, the ability for us to get a pilot done and get them excited is really dependent on the amount of data that we've ingested. So we can't sell the data in bits and bytes and dollars, but what it does for us is when you're dealing with a customer site, we've seen it before, we probably have that recorded, we know exactly what's going on, and we can get to that solution very quickly, build the trust and confidence to move from one building to another. So right now, that's the value of the data. But I think, in my view, and we've been thinking about this a lot, as that data set grows more and more, and let's say becomes more global, which we're working on now, now you've got information on different systems in different jurisdictions with different operating parameters. So where that becomes valuable is more typical to an acquirer who wants to build their footprint and get all that data internal. So a large acquirer, a large integrator would see that as value, and that should drive a premium in the stock.
So what would be the main difference between you and, say, like a Honeywell or any other sort of bigger competitors?
Yeah, so I would say Honeywell is very similar. Siemens and Schneider are similar. So they have their own technology, their own hardware, software, and then they have a big solutions business. So they want to come and solve what they have. So the way we're building our business is very similar. It's got a software platform, hardware platform. Let us do the solution for you in-house and keep that gross margin. So, the gross margins, again, are 80 on the software, 60 on the service and hardware, roughly 37% to 40% on the project. So we actually look like they do, just the scale is different. And we've done that for a reason. It's almost impossible to be a software-only business in our industry. And the logic there is you can have a nice software business, but you're never really going to accelerate your revenues beyond about 5 to 10 million. What you need to do to drive your revenues is also be a project company, because you're solving more problems and getting into more buildings, which in turn drives a software solution. So I would say we've kind of emulated the large caps in our industry, and I think we'll be on their radar once we cross about 50 million of revenue.
Is there any opportunities to sell into the insurance industry in any way? Like, does this, you're dealing with HVAC, you're probably dealing with a few other controls. Anything there? Just.
So I would say what most building operators do is their entire portfolio is insured, and so we would come in and provide a service which kind of helps them keep that insurance in check and balance and make sure that they're optimizing. So in some ways, we're helping the operators lower their costs, not only in their energy and their maintenance, but also their financial. So if you've got data in real time on your building, it becomes a value to you as an operator. We do have some large insurance customers, like Manulife is a customer in some of their buildings. So in that market itself, there really is no reinsurance opportunity, but it is, if you're running a better building, you do get the advantage as an owner and an operator.
Gotcha. So any imminent financing requirements? Are you guys good with where you are?
So what we're in a good position where we don't have to raise capital to operate the business. We're EBIT positive. We're above cash flow break even, which is great, even during COVID. But we've got a nice little acquisition on the go: 4 million of revenue, 60% gross margin, 800,000 of EBITDA in 100 buildings. So we're doing a $1.5 million convertible debenture for the acquisition only. So we raised the money, put it into the deal, put the deal on the books, and that should improve our cash flows by about $1 million on a go-forward basis. And then it's a business that we think we can scale, because we've got a software platform that they don't. They've got a service platform that we don't. So integrating those two could really drive that business forward. And so we are doing a debenture raise right now for that acquisition.
What are the terms on that?
So we've got, it's an 8% coupon, convertible at 50 in the first 2 years, converts at 60 in year 3, so a 3-year term. And it's got a half warrant on it at 60 in year 1 and at 70 at year 2. So kind of interesting, if you remember what I said about the average price in our stock, when the debenture converts, it's going to be around that average price. And again, no cheap paper. pretty good valuation for an investor, and puts that investor right around the average cost of where everyone is right now.
In the event that we've got some listeners that are interested, is there room for?
Yeah, so the book's sitting at about 1 to 1.1 right now. It's because it's a small raise, there's not a lot of room. It is a private placement, and I'm always interested in meeting new investors that are interested in the story, and you never know who's listening. But yeah, we tend to be open about that, and so there would be potential, but it would be limited.
Okay, good. I'll get more details from you. We can sort of further that on to our listeners. Okay, we'll sort of leave this as the last question. Usually a good question, but what keeps you up at night?
So I would say what's really interesting for me as an experience is I think our business is way ahead of our stock, which is really interesting, right? And so, for us, because we're long-term investors and shareholders, we don't really care about the stock price every day unless you're doing an acquisition, where you need a higher share price. And so for me, the idea is, okay, at what point, does our business, as the CEO and also the principal shareholder, at what point does the business connect with the share price? And so I think what keeps me up at night, the fundamental business is great. We want to be more of a public market story, I think, and it's the way we incubated this was private to public. And we want to get the benefits of being public because, really the only reasons to get public, quite honestly, are to use your shares as currency to do things with and to raise more capital to do things with that are accretive, right? And if that isn't conducive, you're better off being private. So I think, and I'm being honest about this, the number one thing that keeps me up at night is having more of a public market presence and making sure that the stock catches up to the business over time. And then the second thing is really scaling the business globally. There's only so many buildings in Toronto, in Vancouver, Montreal. You really have to be a global player in our space. So that's New York, Europe, large centers with large dense populations with lots of buildings. And to that point, I think travel's changing. So I do spend a lot of time thinking about how do we scale the business now that the world has changed in terms of travel. And that's where our software comes in. So that's why we've moved about 6 months ago. We started thinking about an enterprise software platform that we could scale without having to travel. So those are really the two things. And, the rest of the business, I think we're pretty good. But yeah, those two things.
Perfect. So we always like to wrap it up by having guys like you tell us what investors should watch out for, look forward to over the next sort of 3 to 6 months.
Yeah, absolutely. So we've got a great acquisition on the go. We're going to close that. Adds about $4 million of revenue, profitability, and cash flow. We've announced global expansion plans with 2 pilots. And if you look at the history of our pilots, once we announce a pilot, 90 days, typically following that 90 days, there's some kind of announcement with a tier 1 customer. So we've got a tier 1 customer in Europe, about $600 million of revenue, really well known globally. And so beyond that, there's more opportunities like that in our pipeline that we're grooming and developing. And so I think people should just watch for the growth and watch for the tier 1 names that we're adding. And I think it's going to be an exciting time for us. I don't know where COVID's going, and none of us know at the end of the year where that's going to be. But I would say from where we are today, we feel very good about the business today, where the business is scaling to, and what we've done to date.
Mm-hmm. So website address, where can they get more information?
So it's www.kontrolenergy.com, control with a K. Admin@kontrolenergy.com is the principal email. And we've got our LinkedIn page and our social media stuff running, but that's the principal website.
Perfect. Okay, so we've got Kontrol Energy, symbol is KNR on the Venture Exchange, KNRLF on the OTC, 30 million shares outstanding, market cap of roughly 12 million, trading just shy of 1x sales. Paul, I want to thank you for hanging out with us today.
Thanks for your time. Appreciate it.
And definitely we'll look forward to further progress and staying updated. So really appreciate it. I'll hand it over to Trevor. Trevor, you can wrap up, and then we'll leave it there.
Sure. Thanks, Paul. And also thanks, Paul. Just for clarity, it's actually KNR on the CSE, so the Canadian Securities
right.
Exchange, not the TSX Venture. And yeah, Paul, thanks again for your time today, and look forward to some of the corporate developments moving forward, and we'll continue to follow the story.
All right. Thanks, guys. Have a great day. Thank you.
Appreciate it. Bye now.